this is what we're seeing today. What I'm trying to say is that this is perfectly normal. We have a situation where initially people fly into fiat currency, the number one fiat currency, the king of fiat currencies, which is the dollar. And then when the crisis hits, they realize that actually where they should be is in gold. In other words, out of credit. You've got to get out of credit. When the crisis hits, just get out of credit.
In a recent discussion with Alasdair Macleod, the dollar's global position and the increasing prominence of gold took center stage. Gold prices have been relatively flat, hovering near 7-month lows, and December gold futures recently hit a 10-month low. Alasdair drew parallels to the period between 2007 and 2012, when gold initially experienced a drop, but then saw a sharp rise during the financial crisis and its aftermath. It's essential to note that gold had been on an upward trajectory for several years before reaching its all-time high in 2011, nearly touching $2,000 per ounce. Alasdair argues that the value of gold isn't necessarily surging. Instead, the decreasing value of fiat currencies, such as the US dollar, is driving this perception. The decline in the dollar's purchasing power, roughly 7.4% between 2021 and 2022 due to inflation, has been a significant factor. This dollar devaluation has been exacerbated by events like the 2008 financial crisis and, more recently, the COVID-19 pandemic. Furthermore, Alasdair raises concerns that rising interest rates are causing issues in areas such as commercial property and loans. This may lead to potential bond losses for banks, prompting individuals to shift their investments towards gold as a perceived safer haven in uncertain times. Despite prevailing market expectations, the Federal Reserve may surprise investors with another rate hike in November. Pat Lavecchia, CEO of Oasis Pro, suggests that the higher-for-longer narrative has yet to impact the macroeconomic environment fully. Federal Reserve officials assert that they'll need to maintain restrictive monetary policies for a while to bring inflation back down to the Fed's 2% target. However, behind their unified stance lies an ongoing debate about the possibility of another rate hike within the year. Before diving into Alasdair Macleod's interview with Soar Financially, subscribe to our channel and give this video a big thumbs up.
It is creating a lot of problems for all other currencies, really, like huge problems in some cases. So this is very important. If you look at the run-up to any crisis, in our fiat currency world, the first thing that the hot money does is it just gets the hell out of what it's in and gets into dollars, because that is safety. That is perceived to be safety. That's always the first thing that happens. Then there's a sort of second thing that happens. You get the crisis. I mean, we see rising interest rates. I have no doubt that this is creating problems in the commercial property scene. With loans are going to be defaulting. You've got bonds on bank balance sheets in America, which they reckon are something like coming towards $1 trillion of losses now, et cetera, et cetera, et cetera. So there is a crisis. Now, when people begin to recognize the crisis, is at that stage that they get out of the dollar and get into gold. And you see this very, very clearly if you look at what the gold price did over the course of the 2007 to 2012 period. Ahead of the Lehman crisis, gold peaked at around about $1,000. It started coming off as the property crisis was beginning to unwind. And then when Lehman finally fell, its first reaction was to fall a bit further. And I think it got down to something like $680, something like that. And then from there, it soared. And it soared so that by September 2011, it was trading at over 1920. So, this is... What we're seeing today, what I'm trying to say is that this is perfectly normal. We have a situation where initially people fly into fiat currency, the number one fiat currency, the king of fiat currencies, which is the dollar. And then when the crisis hits, they realize that actually where they should be is in gold. In other words, out of credit. You've got to get out of credit. When the crisis hits, just get out of credit. So it's a two-step thing. So, we've had a very, very sharp sell-off in gold, which, of course, has got all the gold bugs, throwing their hands up in the air and thinking, oh, it's the end of the world, or, what's going on? Or I should be invested in US treasuries, not gold, and all the rest of it. Yeah, fine. But, they don't actually realize that this is a 1-2 knockout, sort of boxing match, if you like. And I have no doubt at all that we will see gold rally extremely sharply from current levels, because it's not that gold is going up, Kai. It is that the fiat currencies, in terms of their purchasing power, are going down. And where that is measured in commodities, the representative of all those commodities, including energy, which we're already seeing go up, is, of course, gold. So gold, I'm not factoring any increase in the purchasing power of gold in at this stage. That, I think, happens later on. But for the moment, what we have loss of purchasing power of fiat currencies. That is going to accelerate. And when people begin to realize that that is what is happening, then they're going to get out. And in the case of the dollar, I mean, we're looking at the end of a fiat currency era, and that has been going now for 52 years, since 1971, when it was pure fiat. I mean, it was sort of quasi-fiat before that, by very, very limited convertibility, only accessible to central banks and people like the IMF and so on and so forth. So this is the end of a very long process, during which time an awful lot of dollar credit has been produced.
Alasdair Macleod's perspective revolves around believing that the Federal Reserve has lost control over interest rates, potentially impacting global financial stability. Federal Reserve Governor Michelle Bowman recently stated her readiness to support an increase in the federal funds rate if incoming data suggests that progress on inflation is either stalling or moving too slowly to reach the Fed's 2% target on time. However, the Fed's forecasts, published just last month, reveal a degree of divergence among policymakers. While collectively, they anticipate fewer rate cuts in the upcoming year compared to their June projections, only a slim majority foresee interest rates surpassing 5% by the end of 2024. Alasdair emphasizes that during times of crisis or economic uncertainty, people may lose confidence in traditional currencies like the US dollar. They could turn to gold as a safer alternative to safeguard their wealth.
The point, I think a lot of people, misunderstand the relationship between interest rates and gold. They seem to think that gold has got to have the same sort of interest rate as fiat currencies, and if it gets too stretched, then the opportunity cost of being out of fiat currencies is going to impact on the gold price. I mean, that is probably true when you don't have anything like a financial crisis. But when you've got a deteriorating situation, then it's very, very different. And I would point out that in the 1970s, we went into that era with the Fed funds rate at around about, I think it was 6.25%, round about that, and the price of gold at $35. We came out of it with the Fed funds rate at 19.5% and the price of gold hitting $850. So the idea that higher interest rates are bad for the dollar, no, forget it. It's all part and parcel of the deterioration of the purchasing power of fiat currencies. And as soon as people actually begin to realize that, that gold begins to reflect the fear of the loss of purchasing power of a fiat currency. And that's what we had in the 1970s. We will get it again from here. I mean, I don't actually care, and I don't think anyone should care if the gold price drops down below $1,800 or whatever. I mean, it's completely irrelevant. The answer is that you hold gold not as an investment, but basically to get the hell out of credit. And that's the way you should look at it. And I would say that one thing which will become apparent in the coming months is that the Fed has actually lost control of interest rates totally. I think it's a very important point for people to try and understand, and particularly resident US citizens who don't look at it from a foreigner's perspective. You've got to step into someone else's shoes to try and understand what drives their decision making. And with foreigners owning so much, as I said earlier, 32 trillion onshore, about another. I mean, if you take the offshore stuff as well, we're looking at an overhang of dollar credit, both long term and short term, of about $135 trillion. I mean, this is an unimaginable sum. And it's not going to take very much of that to be unwound at the margin to really impact the US financial scene first and dollars secondly. But as I say, the dollar is going to start going down when people realize that, this isn't just a question of rising bond yields and therefore, attractive and you should hold dollars or you should buy dollars in order to benefit from the rising bond yields. It will happen when we get to the point when everybody turns around and says, my God, we've got a crisis here and we've got to get out of credit. And that's the key thing. And the way you get out of credit is you buy gold, which is legal money, real money, no counterparty risk, and you sleep at night.
Along with their September rate decision, policymakers on the rate-setting Federal Open Market Committee signaled in new economic projections that they're expecting to lift interest rates again this year. If approved, the move would bring the Fed's key benchmark interest rate to a new 22-year high of 5.5 to 5.75%. But could it be the last? Share your thoughts in the comment section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.